All right. Good morning, everyone. Thanks for taking time to jump on the second session of our mortgage protection roundtable. Definitely excited. It's going to be another fun week. We have another set of questions, basically about six of them that we haven't got to yet. And again, we also have, we said, James and Lou on. So won't just be hearing me talk today, hearing some different insights from them, and like I said, getting a different point of view is always valuable. And like I said, we try to keep this one short and sweet. Like I said, it is a short week for us, given the fact that Thanksgiving is on Thursday, so it's a little bit of a short week. So I don't want to keep you guys out of the field for too long. But let's see if we can knock this out in the next 45 minutes or so to an hour. Just to make sure you guys are better prepared going into the short week, but also going into basically the last 3.5 weeks of the actual year. Make sure that we're all prepared and ready to go. And basically, this is a time of year to build the momentum up. As you finish the year strong, to have a good foundation and building block to start 2020 off with. So I think definitely it's a valuable time of year. Kind of you can spend time with the holidays with the family and do a lot of fun, exciting things. But I think it's a good point from a business owner standpoint is to basically finish the year strong, build the foundation, and be able to go into 2020 with a little chip on your shoulder and momentum to kick off the year strong. So, bouncing back inside of things, we basically started with number 7. How to get older people covered that have a mortgage or have a large mortgage. Very common question. And the easiest answer, if I had to give one, it's going to be what we call a payment protection plan. So I know I've talked about that before. There's a couple of videos on my YouTube channel that kind of go into talking about those things, but just kind of breaking it down slightly. I'll use this PowerPoint's a little bit easier to follow. First, the playbook. But the big thing is going to be understanding what is the payment protection plan. So if you can master this style of plan, where it's basically positioning whole life coverage in front of older people, so usually age over 60, or they have some type of health challenges. Like I said, you're talking about an increase in your business anywhere between 30 to 40%. Instead of being stuck only trying to sell term to those people where it's astronomically high priced, it's a good alternative, as well as it's usually the common sense approach is what I call it. It's literally using a whole life product to cover a series of house payments. And I like to show 12, 18, and 24 months worth of house payments. Just like the slide reads, I mean, older folks, health challenge, fixed income status, downsizers, people that are trying to preserve equity. So some people call it an equity protection plan, depending where you guys came from. It's all the same thing. It's all just trying to buy a period of time to get through that transition phase. In this concept, you're not focused on face amount. We're talking about time. And we're trying to buy time for a couple of different reasons. One, to transfer Social Security or pensions. So when someone passes away, there's going to be a drop off of income of some sort. And our job is to figure out what that actually looks like. If it's going to be a huge drop off, temporary, we're just buying time to get through the transition, or we're buying time to set up for a bigger plan in terms of eventually downsizing or selling that home, getting the equity out of that property because she's not going to be able to afford it on a single income anymore. A lot of different reasons. And we don't find out those reasons unless we ask questions, right? So it's a real good plan because it's permanent coverage opposed to a term product where most terms for these situations, especially if they're over the age of 70, you're only looking at about 10, maybe a 15-year option. And with most of those options, depending on the carrier, you're pigeonholing into a $25,000 to a $50,000 plan. Most likely, you're over that $100 mark, $100 a month mark. Most cases. If they're a smoker, you're way over. So it's like I said, it's a good plan just because I use the fact of most people at that age, they shouldn't have term for one. So very rarely do I write a term for someone over the age of 70. But also the fact that at that point in life, they usually kind of start gravitating towards some type of permanent coverage, or they begin to understand the actual difference. they don't know the difference, we gotta go back a couple steps and educate them on the pros and cons of each plan, right? But here's the actual pitch. So, Derek, I always tell people there's a few different ways that we can take care of that mortgage protection, but based on the information before, the plan I think would make the most sense would be our payment protection plan. So the information previous, I'm referring to the house has stairs. They're trying to downsize or sell the house in the next 5 to 7 years. They can't afford it based off their income. They're losing out a big chunk of money from their Social Security or from the pension checks if one of them were to pass away. Those are all little nuggets that I would use and kind of take inventory of to why this plan makes the most sense, and then go back and show them these different points. But the easiest way to explain it, it's a bucket of money with house payments inside of it attached to a period of time, whether it be 12 months, 18 months, 24 months, or whatever time makes the most sense. Each time frame has a different price point. Depending on the option you choose, it will give your spouse that many months of house payments to figure out what option to do next. Look, so that's going back to keeping it, selling it, refinancing. It's a real good plan, just to be able to buy time. And that's probably, this is definitely one of the options where I think a lot of newer agents struggle, trying to cover the whole entire mortgage, or they get stuck on the fact that the lead says it's a $70,000 mortgage, right? We got to cover the whole 70. Unfortunately, that's not true. Our job is to leave them better than what we found them. So whether that be covering the whole entire thing if possible, covering a partial, a third of it, just to buy 1, 2, 3, 4, 5 years of house payments. We call it critical period plan. Or getting them into a payment protection plan to where it's still whole life coverage if they're not going to outlive the actual policy, and it's going to provide some type of cash value inside of it while being permanent. So even if they decide to downsize next handful of years, they can still keep this in place as their burial plan. And they got it many, many years earlier at a younger age, just to be able to help them maintain and keep a better price point on it. So here's just a couple different options of how to show the quotes. I always show the max out, the most possible coverage what the carrier's going to give them. And then I do a 12 or 24, 18, and 12-month option. Depending on their age, you could go down to an 18, 15, and 12, 12, 9, and 6. What usually happens, showing the 6, 9, and 12 plans, they usually gravitate towards the lowest option. So that's where I kind of transition to a 12, 18, 24-month plan, because a lot of the people are going to pick the 12-month plan, a year's worth of house payments, which, given the situation, a year to 18 months is usually plenty. But knowing that there's some people that want to cover the whole entire thing, or for people that have smaller mortgages, say their mortgage payment's only $500 a month and they're fairly young, you might be looking at 24, 36, 48. I mean, 2 years, 3 years, 4 years. I mean, it all just depends on trying to get a nice spread of premium. If you look at this option, they're about $40 difference throughout the whole entire way up. So that's what I'm looking to do, is give them different price points, because you'd be surprised. Some people will say, hey, this one actually makes sense budget-wise, the middle option, but I don't need 18 months of house payments. And then that's where you can do what I call the upsell. Okay, well, in reality, this is really 12 months of house payments, but we also now have $6,000 for burial coverage. So it's a good way to kind of merge the two plans. I do a lot of that if people already have existing policies. We'll rewrite one brand new plan encompassing the mortgage payment protection plan, as well as their burial coverage from their previous options as well. And then the pivoting question, once I show the numbers, is how much time do you want to leave Mrs. Jones, or Mrs. whatever the last name is, right? It's not how much coverage do you want to buy. It's not what option fits budget-wise. It's how much time do you want to leave. Once again, going back to, this is a time sale. This is emotional buy based off of time, not so much the money. It's how much time does the husband want to leave his wife to figure out what option to do next. Does he want to give her a 12-month cushion, 18-month cushion, 24-month? That's up to him to choose, because it's not usually based off of the amount of money. Reason I say that is because we already discussed the drop-off that's going to happen. So whether she gets a greater than 2 Social Security checks, he brings in 2,000, she brings in only 1,000, she's only going to be stuck with $1,000. They're going to be out of an extra, or stuck with $2,000 and out of an extra $1,000. So the money piece isn't really going to matter. It's trying to preserve what they already have. So they're already going to be losing something. So it's a real important point that a lot of people gloss over. They try to make it budget friendly, but you have to also set them up to understand that they're going to be losing money when one of them passes away. It's unfortunately how the Social Security system is set up. If they don't have any outside pensions or retirement accounts to kind of fall back on. So, any quick questions on that thing, or anything 2 cents you guys want to add, James or Lou? You should be able to unmute yourselves.
No, Marcus,
I'm not going to
think you pretty much nailed it.
I got a quick question. You there? Marcus?
Yeah. Yep. Who's that?
Oh, okay. I couldn't hear you. Yeah.
What's going on,
What
John?
if they do? Yeah. Okay. Right. This is John again. What if they do have a pension, and which they've thrown this objection to me before, that they say, well, it's just cheaper if that's the case. I can just take it out of savings or something. I have that. And of course, I would come back and say at first blush, well, that's money that you could be utilizing for other issues. How would you handle that objection?
Like inside of a pension account, like an IRA, or
no?
actual cash
that if they have other savings, however it may be, that they say, well, rather than spending the money on this for a very small amount just to cover a year's worth of mortgage payments, or 6 months or 18 months, whatever, I can just take it out of savings. How do you handle that?
What was the original purpose of your savings? Was it to take care of the house payment? I would ask them, what was the original purpose of that savings? Was it designed to take care of this house payment?
Well,
let's just say
there's no general plan. They just have that money for savings for any kind of emergencies, and this would be an emergency, so they could utilize that. How do you get around that?
Yeah, so it's asking that question. So if you basically found money by asking the right questions, you would uncover that savings account first. So ideally, a payment protection plan probably isn't their best bet. It's using that money inside of a single premium, inside of a pension protection plan, if you will, leveraging their assets to cover their mortgage payments, getting the interest on it. So I mean, it really just depends on what that money's for. When people have money, I always ask the question, what was that for? Because typically speaking, before you got there, that money was not to pay off the house. It was for something else. They already had that money spent for. The story I usually am getting, it's money inside of CDs accounts for the grandkids. So yes, you might have 5, 10, 15,000 put up, but that money is allocated to be left behind to those grandkids, not to be used for the actual house. So uncovering what that money's for and identifying how it's going to be used, because if they just say they have a bunch of cash laying around, there's two problems. One, we didn't ask enough fact-finding questions to start to uncover that money first, so it can't be used against us, as well as uncover that money first so we can use it to our advantage, because they might not need the whole life plan. If they already have cash flow, it could be a better place that, hey, let's take $3,000 or $4,000 or $5,000, let's put it to a single premium, let's double the money, or pretty dang near close to it. Make one premium payment versus having a monthly payment. So it's leveraging their assets to your advantage. But I think it comes down to asking the questions first if that does come up.
All right.
That I know it's a blanket answer, but it's when the cases that I've had
it's a
dealing
good
with
start.
that.
I'll talk to you more about it, but yeah, that's a very good start. That's fine for now. All right, thanks. Appreciate
but the big thing though, it's going to be pain. I mean, if you're dealing with someone that has cash and they're losing money in terms of there's going to be some type of financial drop off, ideally they're not going to touch their savings account, because that's what's going to be making it the actual difference. So Mrs. Jones and Mr. Jones, he's bringing in $2,000. She brings in, say, $750. That drop off of when he passes away, she's going to be out of that extra $750. That savings account's what's going to hold her on to keep her going from this, give her the same lifestyle until that money runs out. So even then, the payment protection plan, if you can trade a company $50 per month or whatever the price of it is to take care of 12 or 18 months of house payments, it's usually worth the $50 spent to get get the bigger check.
That's a good point. That's a good point.
Because at that point, you're trying to do the math problem. Okay, if I can save this people happens all the time too. Well, I can just save $100 a month. Yeah, that's a great plan while you're alive. If you die tomorrow, the most you have saved is only $100 compared to getting paid out $5,000. Which one would you rather have, Mr. Jones? $100 or $5,000? Which I've gotten that blunt before with people. It's part of the business. It's being bold and uncovering these things that come up multiple times. And a lot of times people try to save the money that unfortunately doesn't need to be saved, because it is a better play to have the insurance product. If you can pay an insurance company, even if you pay for a whole entire year, $1,200, and then you pass away, you still get 5, 6, 7, 8 grand. That's a better deal for the client than it is the insurance company, right? So sometimes the math has to come into it, but typically speaking, from your first question, I would ask a lot more questions to start. So that's why there's a savings question in place. Do you have anything that acts like life insurance? Those are the questions that will uncover the money first for you, so you don't run inside that trap. It's a good question, though.
Okay. Yeah, great. Thanks. Appreciate it.
You had something, Lou, before?
No, you nailed it, man. You had to ask him probing questions, and that was a great question by John, I think his name was. And I think it really depends what they have in that savings. So I mean, if they have an old 401ks or they have $100,000, it's a lot different than if they have $5,000 in savings. I mean, obviously emergencies happen all the time. If they only have $5,000 in their savings and they need a new roof or a new refrigerator, I mean, that could take up to half of that savings that quick. So it'd be important to put something in place. So you nailed it, man. Let's get on to the next one.
Let's do it. Next, number 8. How do you overcome the "I want to think about it" objection? So, if you don't mind, Lou or James, you guys want to give yours? I'm curious to hear what you guys do.
So whenever somebody says that they got to think about it, normally my first rebuttal to that is like, hey, great, listen, I understand. Since this is an insurance product, it's not given. It's not given outright. So that means like the companies actually have to think about this as well. So how much time do you need? Then they'll ask, I'll be like, do you need 2, 3 days, a week? And then they'll say, just a couple days. I'm like, awesome. So all we're going to do today is we're actually just going to see if you can get approved. Okay. Because the bottom line is, if you pass away tomorrow because there's some underlying condition we don't know about, then they're not going to approve you. So they first need to actually approve you for this product before they can actually grant you this benefit to your beneficiaries. Do you understand? And say yes. Like, okay, great. Just go ahead and grab your ID and we'll go ahead and see about getting you approved for this program. So if there's a second objection, say as far as, well, I just don't know, then you ask them like, okay, so do you understand, is it the concept that you don't understand or is it the price that you don't understand? So 9 times out of 10, it's going to be the price. Because when you ask them, do you understand the concept? So 9 times out of 10, they're going to say yes. So then when you follow up, they're like, well, most people, when they understand the concept, then it just boils down to price. So is this price uncomfortable for you? And then they're going to say yes or no. And they say yes. They're like, okay, well, let's go ahead and reallocate this and go ahead and try to make something that not only fits your budget, but then gives your beneficiary the benefit that they need in order to go ahead and handle this situation if or when you do pass away. And that's when you just follow up and try to reallocate the funds.
No, I like it. I mean, very, very similar. Because that's the usual objection of, guess what? While you think about it, the carrier wants to think about it also. So I think it definitely works. I've gravitated to using that one as well as an additional one. Mine's a very straightforward one. So when people kind of give me a lot of pushback, because I want to think about it, it's really just smoke. I might sound weird to some people. No, they actually want to think. No, trust me, it's just a way to get you out of the house quick. The idea behind I want to think about is uncover the real problem. Is it, like James, is it money? Is it concept? Is it trust? So the way I kind of tackle that is, okay, Mr. Jones, let me ask you, if you don't mind, let me ask you a straightforward question. Because usually when people want to think about it, it's for one of three things. I'm trying to see which one is it for you, if you don't mind me asking. I mean, is it, you want to think about, is it too expensive? You don't think you need it, or you don't trust it? And then it's a straightforward question to put them kind of on the spot, which that's what you want them to do. Because the first thing they're going to say is, oh, no. Two of those three things they're going to say, no, that's not the case. It's usually the fact that they actually do trust you, and they do think that they actually need it, and it comes down to price. So usually I want to think about it, it's usually a budget issue. Or I've had someone say, well, hey, it's the money's fine. I totally trust you. But I just need to, I don't think I like the concept. So that could be, we could be hung up on a renting versus owning. So a basic plan versus RLP, or a whole life policy versus term. So there's something underlying there that comes up. And then the one guy, literally, I had a guy tell me this. I mean, he literally said no to all three of those questions. But then after we kind of went back and forth on, I'm like, so what is it then? He's like, well, I just got a brand new job. And this is my 4th week into the actual job. His paycheck didn't start till that actual week. So yeah, I need like another 3.5 to 4 weeks to get my second month in and get 2 more paychecks in. So literally, it wasn't that he couldn't afford it. He was just unsure of his actual budget in terms of what money was coming in, because brand new job. So more of the actual story, whatever objection you want to use or the rebuttal to overcome it, make it lead to some type of place. Either you're leading back into the application of, hey, while you think about it, they're going to think about it also, or just go straight for what I call the jugular. Get the straightforward answer. What is their actual hang up? Because if it's something in the presentation wise, it's something that you can circle back to. Unfortunately, you can't make them trust you more. You can fix price, and you can fix concept if they actually need it in terms of product style. But so usually 2 out of those 3 things, you should be able to fix it, and it usually relates back to the actual presentation or adjusting the amount of coverage to make sense budget wise. So if it is a budget issue, because I mean, it's in my presentation, it's designed to basically overcome that objection first. Hey, we're not here to break the bank, get them to laugh and kind of chuckle a bit. But if they pick an option, and then they come back on that option, yeah, that's not going to fit budget wise. Don't keep going down that same list. Ask them, what is affordable but budget wise. Get the exact number and just run the numbers backwards. So they go from $80 a month. They're kind of wishy-washy, and then he says, well, I think we really can comfortably do $50. Great. Grab your ID, or what's your middle initial. Those are the 2 questions I usually like to ask, and then start doing the application. Because at that point, it doesn't matter how much the coverage is. It's finding something that fits budget. Because he already has an idea of what $80 is going to get him. So say if $80 got 100K, well, we're going to know that $50 might get him about 75,000, right, or whatever the number actually is. But it doesn't matter. It's a value sale based off of price from that point. So that was good, James. Appreciate you doing that, brother.
Yeah, man, no doubt.
Moving on to the next one. I just want to shop around, or I have some other people coming out. It's probably a fan favorite if you're in the mortgage protection space, where there's a lot of groups mailing a lot of data, and a lot of the newer, fresh front end leads. There's a lot of companies mailing it. So this one is very frequent sometimes, but I think it's very easily done just by presentation. So what I usually do, I just want to think about it, or excuse me, I'm just shopping around, or I have other people coming out. So I use something I call the I am your policy. So if you're looking at this from the actual screen, it's the American Amicable poem put onto basically my letterhead or my leave behind form, print this on cardstock, maps out carrier, policy number, name, coverage, their monthly premium amount, and their draft day. 2 different boxes I can put down to his and hers, as well as at the bottom has all the different carrier logos. Basically, anyone that we sell or I personally sell is going to be on this sheet as just a visual tool. It's just a visual, because a lot of people recognize the logos more than they do the name of the actual company. So when people say they already have something in place, or we got coverage a couple months ago, I give them this thing. It's any of the companies we already work with, and that just kind of gives me some intel of what's going to actually happen. Am I able to fix it? Are they in a better product? Should I leave that thing be? Should I make a phone call to the carrier? It just gives them a sense of, one, you get some credibility, because to be honest with you, people are going to recognize the top three companies, at least from a marketing standpoint. Mutual Omaha, usually the first one. Everyone knows those guys. Transamerica, and then Gerber. Occasionally, you get an AIG. Someone recognizes those guys, or Nationwide from their GI product. They know them from the auto insurance side. But usually, Mutual, Trans, and Gerber are kind of the top three companies that people will recognize at some point. But this, like I said, it's just a crutch. It's just a tool just to kind of show, hey, we're actually brokers. So when I say we have about 15 different companies, 80 plus products to shop through, we're not BSing it. I mean, we do have a handful of products at our disposal to use. So this is what I use to kind of help say, hey, here's everything that is fully available. So my job is to work for you. I'm a consumer advocate. I don't work for the insurance companies. I'm not loyal to just one. I want to make sure we get you the best possible deal. So this goes back to, one, your actual presentation. So make sure you have the foundation when you do the storytelling in the very front of that. But also, like I said, I use this tool as a crutch just to be able to show them something. So as I'm talking, they're looking through this. They're looking through the in-home process sheet, the visuals. I didn't pull that one up, sorry. But they're looking at these things as I'm talking, and they're it's kind of building the rapport on a subconscious level. They're seeing all the different companies. So I'm telling them, I help them shop around, find a better deal. They're actually going to buy into that as I actually am shopping for them, right? So that's what I like to use. And once again, it kind of circles back to those same objections. Shop around, I have someone else coming out. We have this many companies. Unfortunately, we all kind of sell some of the same products. Some are going to be similar, some are going to be very different. At this point, and for the number 9 question, you're really selling you. It's how can you go the extra mile? How can you be a little bit different? So I had an appointment this past, I believe it was Tuesday night. The person sent in like 20 cards. So they said they've been called by a bunch of different people. They had an appointment that Tuesday at 7. I was able to talk my way into the house first. Say, hey, I can swing by before or after. You do 6:30 or do 7 or 7:30. They ended up saying come out prior to. And going through the whole entire pitch, other agent shows up. Very awkward. I love those moments because I think it's funny. But she's basically we invited her to sit down and show numbers at the same time, just to save time for the actual family. She didn't want to deal with it, so she kind of sat down and just waited for the next hour. Went through everything, but I think the saving grace for me, like I said, don't know who she was with, what kind of company she was showing. They were daughter or sister rather. She was recently put on disability two years ago, as well as mother just turned 69. So in my head, during AEP options, say, hey, we also do this. We also do Medicare. We need help figuring those options or getting updated plans. I'm more than happy to talk to you guys about doing that. So saving grace, I'm just shopping around. Like I said, the real way to actually overcome it is to provide more value for you personally. So the way I've been doing that is just be the extra little things we're able to sell now and offer due to having a health license or due to adding Medicare to the actual pot goes a long way in making yourself stand out from some of the other agents, especially in the mortgage protection space, where I think a lot of the people, they're going to be honestly probably using some of the similar carriers, some of the similar concepts. It's how can you stand out throughout the clutter, and adding extra values or extra services that you actually do, and make yourself stand out and not be too pushy of a salesperson, I think will make the world of difference in actually closing the actual deal if people didn't want to shop around or they have someone else. Because basically those are all objections for, I think I can find something better. That's literally what they're telling you. It's, I don't trust you. I think the next guy will have something better and cheaper than what you're actually showing me. So if you're in a payment protection plan situation, it's a great time to pull out Best Plan Pro and show them the actual, hey, you just shop through 15 different whole life options. Here's the literally the price breakdown. Here's the better option. Here's the best one for your given health. Using those different tools are going to be a huge added bonus for you. Anything you guys want to add, James or Lou? I want to think about, or I want to shopping around, or I have other people coming out.
Mario, I think you pretty much nailed it on the head. The visuals are, I mean, they make a complete difference in the in-home. As far as just showing the carriers that you are either appointed with or you have affiliation to, and then using that Best Plan Pro. Literally every appointment I go into, if it's like going down to like equity protection or a final expense type of plan, after talking to them about the concept and making sure that they understand it, I literally just put in their information into the Best Plan Pro and I flip it around and I show them that that's the best opportunity for them. There's even options as far as like doing even minor upsales. If say like Mutual Omaha's $2, $3, $5 cheaper, but then you got American Amicable. Well, American Amicable has a nurse rider on, or a waiver of premium rider on it. It's nursing home waiver of premium, meaning if they go to a nursing home, they don't have to pay for their insurance anymore, and they get to keep it. So I find a lot of value in that. And yeah, it might be a couple dollars more, but at the same time, you can show that value to them. And then once they understand that, then they're more than willing to go ahead and actually buy a couple dollars into that extra value. So, but yeah, visuals, awesome. Best Plan Pro is on point in those type of situations.
Yeah, it could be the big thing. It always boils back down to trust. I mean, when people, they want to shop around, it's us failing to do our job to, one, create the urgency behind it, and two, to build the rapport and trust with them and give us some type of credible edge, whether it be, like I said, showing a visual, using our software to our actual advantage. Like I said, now just because you show them the cheapest company available, don't be afraid. Like James said, look at the other options. Be able to know your products well enough to say, hey, here's why I like this company. Yes, on the sticker price is a couple dollars more, but Mrs. Jones, in the insurance world, you kind of get what you pay for in some cases. Not all, but some. Here's why this company's a little bit more money. They have XYZ rider, this one, and this one. Or they offer an accidental death rider while this one doesn't. So understanding that, as well as being understanding how Best Plan Pro works as well. There's ways to edit out certain carriers. So if you don't use Trinity a whole bunch and they come up the lowest of the low, then maybe exclude them from what you actually do, just so you're not screwing yourself up by showing those lower options. But also understanding the different metrics behind each of those companies. So understanding, hey, this one company's lower because they offer less benefits in terms of riders, or looking at from the death claim paying, are they paying a higher number, lower number? A lot of those different things matter when explaining the actual client, the actual product. So that segues right into number 10. So a lot of people ask questions. Well, hey, I'm used to using Best Plan Pro for final expense. How do you underwrite mortgage protection? I wish there was an easy answer. Unfortunately, there isn't. So underwriting mortgage protection products is a couple different tools. Now, I think Casey Life is going to be the first company coming to BP, Best Plan Pro. It's not official yet, but I'm pretty sure that they're going to be the first ones for us. But so yes, it is coming. But understanding, term is a very different beast than the final expense products. So term is not as black and white. So what I mean by that, in their agent guides, inside their questions, there's literally yes or no questions. Meaning, if they have this, it's going to end up being this, right? Well, term, it's kind of a lot of gray areas. It's what I would call a point-based system. Some carriers confirm that, some carriers kind of deny that. But either way, it's usually built off of some type of tables. And most of the companies that we use will be standard price till table 4. So what I mean by that, if you're using a true simplified issue, mortgage protection style products, up to usually 300 to maybe 400,000. Most of them are going to be on some type of table system, meaning they'll take anything from no meds to a couple different things going on at the same time up to a table 4 standardized price. Once it gets beyond that table 4, that's when it goes to an instant decline option, right? Unlike some other carriers that are non-medical but not a true simplified issue, they might table rate that actual case 1 or 2 tables and charge a little bit more money in order to approve that client. So understanding the difference between a true simplified issue mortgage protection product versus a non-med mortgage protection style product or term case or term product, excuse me, is very, very different because it's all based off how the underwriting actually works. So with that being said, we have our common term underwriting first look. So this is on my Dropbox, Google Drive, as well as this inside the MP playbook. Basically, these are all cases from other MP agents as well as myself in the last 5 years of real life cases that we have gotten approved from these actual carriers. So, for example, diabetes, type 2 pills only. Foresters, AMAM, home protected, mutual home health, TLE, if diagnosed past age of 50, and so forth. Basically, it's just the top 3 options of what usually it gets approved and how. As well as some of the more frequent style questions. So on the MP side, you're dealing with usually a lot of blood pressure, diabetes, occasional anxiety / depression drugs, inhalers every once in a while. Arthritis comes up from time to time, especially for the people that are usually over the age of 45, 50. Occasional digestive issues like Crohn's, ulcerative colitis, major heart issues like AFib, mitral valve prolapse, some angina stuff. I mean, you get a couple weird things. Cancer, that comes up every now and again, as well as best options for living benefits, return of premium with living benefits. And then at the very bottom, there's a couple little care niches, what they do and what they don't do. So, for example, Mutual Omaha and Kansas City Life, they both take diabetes diagnosed at the age of 50, regardless of treatment. It could be pills, it could be insulin. Doesn't matter. As long as it's after 50, they will still take that. AMAM on their home protected product, they only have 7-year questions. While most other carriers that we're looking at are going to have you ever's in the last 10. And there's a couple in the last 3 or 5 for like driving and so forth. Foresters will take people that smoke and have diabetes. That's almost a decline every other place else. So like I said, fortunately, this is not a real tool in place for underwriting other than what I would call trial and error. But this is a good crutch to have just to be able to help look at some of these common cases that do come up quite frequently. But the big thing for term, said 2 or 3 things. If it's more than 2 things going on at the same time, it's definitely ideal risk assessment situation. Call into the underwriting team, give them the specs, the client's age, gender, tobacco status, height, weight, and current medications with corresponding ailments. And then usually they can spit out an answer for us and tell us, hey, this will fly, this will not fly, or this will be good, but on a whole life product instead. They'll give us a good round, analysis of that situation. But for the 1 or 2 type things, this is a real good tool to just be able to help figure out where's the easy way to place things. Like I said, with a couple newer carriers we're starting to get our hands on, this will probably evolve down the road eventually once we kind of get a better picture of how National Life actually underwrites, American National, and so forth. But right now, this is literally all the non simplified issue non-medical products are on this sheet right now. So it's the more true mortgage protection products. Are there any questions on that? All right, nada. That's good. So next topic, which I think this should go actually. Actually, use this. So some of you guys might have seen this on the university page. So next thing, situational concepts. So I'm going to run through this pretty quickly. Like I said, this is already a video that I have posted, but just to kind of get some people some good nuggets inside the right thought process. Young and healthy, people that are 18 to 45. So typically speaking, this is where I like to load people up. So what I mean by that, that's where I'm looking at return of premium, disability, waiver of premium options, accidental death. All because one, they're young, they're healthy, they qualify for it. But two, it's also to hit the minimum premium. A lot of these cases where people are in their early 20s, mid to late 20s as well, they only have $100,000 or $200,000 mortgage to where the minimum premium, I mean, just to hit it, I mean, if you did a normal case, it's only $15. So trying to hit the minimum, which is $25 with most companies that have the minimum option, you have to add a lot of different riders to it. So adding the disability, the return of premium, waiver of premium options, or even accidental death, it's helping get that case to that $30 to $40 price point. Whenever looking at MP cases in general, I'm always trying to get the lowest option that I show to be the cost of the actual lead. So if I get a case to be 40 or $50, I'm doing pretty dang good. That's kind of the lowest price I like to show is $40. If I'm getting below the $40 price point, that means there's a handful of riders I probably could be adding on and giving a lot more value to that actual client. Like I said, that's personal preference. You don't have to do that. I just like to. $40 seems to be the worthwhile premium because usually a $40 case, no matter what your contract level is usually enough to either pay for half of your batch of leads or almost the whole entire batch. So it's a good happy medium. $40 to $50 is a good solid number to one. You want to be profitable while you're actually doing this stuff too. So next market, 46 to 60, the middle age is middle market America. I mean, you're selling a lot of different types of products. I mean, between your 15 all the way up to a 30-year term, same benefits and riders apply. So your ROPs, your disabilities, living benefits. Could be a real good option for your UL products and kind of getting them set up on the ideal of having something more permanent that's going to last them a while. But the major techniques to use, at least on what I've actually gotten, is going to be it has to be the ground floor concept. It's taking the people that want all this disability concept and worry about loss of job into the real picture of what if that same thing that can actually disable you actually kills you. Because a lot of times at this point they're going to have some type of disability through their actual employer if they've been working for a while or they've had a real good job. So adding on a separate disability sometimes isn't always the best fit. It's leveraging what they already do and maybe adding a little bit to it, but it's really getting the folks on the death benefit, having coverage that they own outside of their actual employer, that they have power behind, that's going to move with them, it's going to change with them if they want to make adjustments as their life changes, or even the critical period plan, along with the 50-50. So those are critical periods using, say if they have a $200,000 mortgage, I'm trying to sell 50 to 75 grand to take care of 2 to 5 years of house payments. Same thing can be said on a 50-50 plan. If they have $200,000 mortgage, especially for smokers, there's a real big deal here for smokers. 50-50 plan is taking $100,000 base to $100,000 accidental death. The way the actual tables work, as long as you're under the age of 65, you're more prone to die of an accident versus natural causes. That's just the actuarial tables, right? So it's leveraging that exact stat to our advantage and keeping the premium down for the actual client. Now, do I show them a higher price? Yes. But I tell them, hey, the chance of you dying of an accident over the next 15 to 20 years is more likely than you dying of natural causes. So it's an easy way for us to hedge the bets into your favor and save about $50 a month to do the same thing. That'll be the difference between a 200,000, 200 versus a 100 and a 100 accidental, right? So, real good plans that middle market as well as for very good for smokers and get that cost back down to what's something that's affordable for them. You're 61 to 67, or excuse me, 61 to 70, the retirement era. I mean, you're looking at 10, 15-year terms. You're looking at the critical period plan, which is using term to cover a series of house payments, along with the payment protection plans we spoke about earlier. So, real good age to get into those whole life options, as well as if these people are actually healthy, don't be afraid to give a universal life option a look. So a GUL style product, like for example, I'll just use this comparison because it works. If I'm writing a mutual Omaha policy worth more than $18,000 whole life coverage, I typically can write them a Forester Smart UL and give them an extra $7,000 for the same exact price. That's with the target premium and everything. Just so run those numbers side by side if they are healthy enough. Sometimes the GUL that's properly funded can give them more coverage than what a traditional whole life product can. Doesn't always work. It does work in some cases, but also can allow them to get over that $40,000 amount. Maybe get 50, 45 or 50 grand for the same price that a $40,000 whole life policy costs. And now they're into living benefits. Now they're into cash value with interest being grown. The little trick is that's just how the numbers work, but you got to make sure you're funding these products properly as well. So, and then last but not least, the senior with a mortgage, 71 to 80 plus. Like I said, there are a couple term options still kicking. Ideally, going to be 10-year terms. You could put emphasis on living benefits, but like I said, at this age bracket, I'm definitely putting a lot of time and emphasis on a payment protection plan. Using it as a 2-for-1 vehicle, a vehicle for if they decide to keep this house for the next remaining years and you pass away, it's enough to take care of a period of house payments. Or if they're planning on selling the house at some point, they can still keep this plan in place to help take care of burial expenses or their final expense option, given the fact that they've already bought it 5-10 years earlier versus waiting to the very end to get this type of policy. So with that, are there any questions on any of that stuff? I know I went quick, but like I said, there's a couple videos already in place that kind of explain this stuff in the more in-depth option. Nada. Okay. All right, and last two things. So, what does a typical work week look like? Go ahead. Someone's asking something.
I was gonna say you're just nailing everything, Marcus.
Hey, I'm trying. Hey, you want to throw anything inside there, James? Go for it, man.
No, you're good, man. I mean, it seems like everything that like worthwhile being said, you already said it. So just keep on doing your thing, man.
Gotcha. Yeah, like I said, we think a very a lot alike, which is good, which is why systems work because we run off the same tracks. So it's more reason for people to plug in. So plug into me, plug into James, plug into Lou, any other MP agents that are around there. We're all pretty much running off the same track, and it's the big thing is definitely checking your baggage at the door and being open to learning something, because there's obviously a system in place that works, not just for me, but for other people as well. And the way that they do things has been very lucrative and productive for them. It's just taking the time to actually sit down and learn it with them and be open to actually doing it. So I think there's a lot of the issues that we see are pushbacks of people struggling. It's when they don't actually plug into the actual systems in place. So so there's a lot of this stuff. I get a ton of questions on it just from the sales trainer aspect of it. So that's where a lot of this content was made, just to mitigate the number of questions of the same thing over and over. This stuff is everywhere. Trust me. It's on my YouTube channel. It's on the Google Drive. It's on the IFG University page. This stuff is everywhere for people to plug into, get their hands on it. That's not even including the playbook for people outside of the actual group. But typical work week, like I said, I like to dial on Saturdays. It gets a little bit wishy-washy during college football season, so I'm not going to be one up to a lot of you guys. But typically speaking, if I dial on Saturday, whether it be in the morning session from 10 till noon or 10 to 12:30ish, and pick up again in the evening between 4:30 and 8, I'm booking for Monday and Tuesday appointments. If there are weekend people, I might open up that Sunday as an option, but typically speaking, I dial Saturday for the next 24 to 48 hours. Sunday being the one day that doesn't really count towards that timetable. So you're looking at Monday, Tuesday appointments. Wednesday is going to be the admin day. So any type of pending business, getting things signed, amendments, questionnaires, all that stuff that's never fun, that's usually what Wednesdays are for. It's a lot of office stuff, a lot more phone calls, helping my guys figure things out. And then Wednesday night's going to be kind of the dial session for me. I'm trying to book up for Thursday, Friday. And then rinse, wash, repeat, do the same thing the following week. Some people, if you're traveling to an outside territory or you're going more than an hour and a half away or 2 hours away, I definitely recommend a two dial day session. So you might be dialing Saturday and Sunday to book up for one day. You might try to get as much as you can from a 2-day session on inside of a Monday or inside of a Tuesday, just to maximize your time there. So you can either do that on the weekend, or your session could look like a dial Monday, Tuesday for running days, Wednesdays through Friday. Try to stack up as much as you can while you're down there for those three days. So that's usually the schedule I do if I'm traveling somewhere. I'm going to a different state that I have a non-resident license in. I'll spend 2 days dialing very, very hard. Well, what I mean by hard is it's harder than my normal phone calls. One, you're not from the area, so I can care less what people think. At home, a little bit different because you got to go door knocking eventually. But if I'm somewhere else, yeah, I'm dialing 3 numbers back to back. I'm dialing regular number, private, regular number. I'm going to hit them a 2-hour stint. You're going from say to noon to 2, hit them again from 4 to 5, and again from 6 to 7. I mean, you're going through that thing a bunch. So average session, I mean, some people break it down by hours, some people break it down by number of dials. So for a newer agent, I recommend 150 dials. That should be your average session, your first starting session. That 150 dials on B leads should net you anywhere between 20 to 30 conversations, hopefully booking 3 to 5 appointments. So it's usually a 20-to-1 ratio with B leads. So A leads, I dial, it's right about a 9-to-1 ratio. So every 9 phone calls equals one appointment on A leads. So that's not just brand new freshmen off the printer same day, but also throughout the rest of that month, because my pile is usually it's a pretty decent sized pile. So, but usually it's 9-to-1 ratio for A leads, 20-to-1 ratio on B leads. James, you guys want to add anything to that? Dialing through B leads and any of that stuff, or what's your work week look like on your end, James?
So yeah, mine's pretty different. Like today's Monday, so normally I do dial days Mondays and Thursdays. Mondays just to book up for Tuesday, Wednesday, and then Thursday to book up either Friday and Saturday, or Friday and Sunday. It's all about like geographical location. If you're in the Bible Belt, then obviously, you shouldn't be booking anything in the morning time on Sundays, but you'd be surprised the amount of people that will actually sit with you like in the afternoon. I'm not sure if you went over this or not, Marcus, but the whole 3 dial in a row, I came to find that there's a lot of value in that. So,
for sure.
There's a lot of agents that will dial one time and then go to the next lead. But if you think in the way of the consumer, typically you won't answer the phone call the first time just because you don't recognize the number. But I'm even victim myself whenever, somebody's calling me 2-3 times in a row. One of those, other times I'm actually going to answer the phone. So it's one of those situations where, you got to just be able to get out of your head as far as attacking the phones, because the phones is going to be your main opportunity to be able to make a sale, aside from just door knocking. But if you're efficient as far as the phone call and the phone conversation is, then you'll be able to book a lot more stronger appointments, which will lead you to more opportunities to sell something. So I know one of the biggest things that, people are like, well, I'm just bothering them, or, I might be annoying them, but you got to think about it in your head is these people actually filled out these forms. So it's not about you bothering them anymore. Now you're trying to reach back out to them, and in doing so, they're taking your time. So if they're taking your time, then obviously you want to be able to take care of this as soon as possible. Hold on one second. We got this huge office, and they want to stand right next to me while talking. So, anyways, so in that particular circumstance, if they filled out a form, they're asking for your help, then when you call them, they don't answer the first time, then obviously they just don't recognize your number. So you call them 2 or 3 more times, and then when they answer, then you call them by their first name. They'll totally forget that you even called them 2 or 3 times. So you call them by their first name, then they're like, oh, well, hey, these people might know me. And then after that, you go ahead and approach them like, hey, Mr. and Mrs. Smith, this is James with the Benefit Center or the Mortgage Protection Center, just reaching back out to you about that little form that you filled out and sent to us. You remember that, and you just go on with your approach on the phone. So, but that's pretty much what I got, Marcus.
No, man, that's spot on. I mean, a lot of people create objections inside their head and actually think them into existence when they're not really there. That's probably one of the biggest pitfalls of a brand new agent, as well as you won't understand the value of the phone calls you're actually making until you call someone and they passed away. So I've had that happen several times where I've been trying to get a hold of these people. I've been, whether it be emailing, texting, the whole nine, which text is another big way of actually getting a hold of people now. The importance of what we do doesn't hit close to home until you call a lead card and that person's passed away, and you what you could have done, or what we actually do, is what could have prevented them from being homeless or giving them wife a little bit of cushion. So that hits closer to home once you get some of those phone calls, which a lot of newer agents, like I said, it hasn't happened to them yet. But when it does, just take our word for it. It gives you a whole new perspective and thought process of dialing through leads. You're not bothering people. It's our job to have urgency and get this information out there as fast as possible, because tomorrow is never promised for anyone. So, with that being said, I think that's it. Any questions from anyone? Anyone got any things they want to share?
No, man, appreciate you. This was a good session, back-to-back session. So thank you for your time, bro.
Oh, you're definitely welcome. Well, hope everyone, like I said, if you have questions, don't be afraid to reach out to myself, James, Lou. Post on the Innovative and Friends website or Facebook page, excuse me. More than happy to answer them. Like I said, I should get this one up there today, next couple of hours. But hope everyone has a real good holiday week. Finish the year strong. Like I said, keep the momentum going. Just like I said, there's about 3.5 weeks of working weeks left, if I would call it that. As well as, like I said, there's different resources available. So I didn't cover this, but it's on the screen. IFGMP, that's going to be the bit.ly link for our Google Drive, which has a lot of this information there. bit.ly /AmpLife YouTube, that's my YouTube channel. So a lot of the videos I post, or even these playbacks that I do, I post them there, as well as the MP playbook will be the last one. That's my book that I've wrote. Basically everything you see inside of these different things that are numbered, objections, the whole entire 9 yards, that's the MP playbook. So at some place, there's going to be a big chunk of this content that's already given out for free as the university grows. We're shooting videos for a lot of this stuff anyway. So if you want a paper copy of this stuff, don't be afraid to reach out or hit that link, and that'll direct you guys to that thing. But once again, have a good holiday week. Enjoy it. And then we'll pick this thing up next week, maybe with a new topic, or depending on how questions go, maybe have another session. So until then, you guys enjoy it. Have a good holiday. We'll see you guys next week.